this was one of the first things we had done in terms of the calculations. And this is your 35 mark question. We probably did this already in class, come to think of it, but I'm happy to go through it again. And I'm going to highlight a few things. There's a lot of things going on here, but we'll try and cut to it and go straight to the solution. So the first thing we want to do is identify that you have imports from Ethiopia. You're also exporting to Russia. Okay, that might be important. Your imported goods are valued at this, and your exports. So if you recall the way I would have set this up in class, I would just concentrate on one of those firstly. So I just list out the imports. I would say Ethiopia, 2.62 million birr. And I would also say 3 months credit offering 2.5% discount. And then I would start when I've complete all of that, I would go to the exporter side and I would note that the 4% discount is given for Russia. The spot prices are all important. I would just note the spot, but using the bid or ask is a thing we have to set up. So if you happen to have a pen and paper handy, I think it'd be okay. I think it's a good idea to just refresh and just write down the few things I'm going to say here. Obviously, you don't have to write down everything because the solution is in I'm going to show you the solution in a moment. But I would write in which spot price we're going to be using. And then I'll just ignore all this. I'll worry about all the rest of this information when I come to it. Okay. And 20 marks, we want to find out which hedging method we should use. And you'll see here that you have the forward and you have interest rates. Again, this has nothing to do with that topic we left out. This is the foreign currency borrowing, this part of it. And we did that at the beginning of the semester. So you only have evidently two types of hedging methods, but if you go back here, we're told that you can make payment today, or if they pay immediately, this is another hedging method called lead to payment. So we've got three of them: lead payment, forward contracts, and foreign currency borrowing, or the money market hedge. Okay, solution. Well, I haven't gone through this solution. There might have been a few adjustments to it, and if there are kind of some errors, if you have a calculator handy, we can work through it, just in case there is an error in the solution. So the first one we'll look at is lead to payment and I've chosen the exporter at the beginning. So I'm just going to slide back up here just to remind myself that we exported goods to this value. We have 4 months credit and we have a 4% discount. Okay. And we have to use either the bid or the ask. Can anyone tell me which of those for the exporter we're going to use, the bid or the ask rate, and why?
It'll be the ask. Well, is the ask same as the offer? Because in an exporter, the customer uses the offer to buy the home currency.
Yeah.
The customer uses the bid to sell the home currency.
Okay, so this is what we were saying you need to write down, and it's a good idea to do this. So the customer uses the bid to sell the home currency. Think of CBS. So the customer uses the bid to sell the home currency, and the customer uses the offer to buy the home currency, or the customer uses, in this case, the ask to buy the home currency. So think of CAB or COB. So what's the home currency? We are based in Ireland, so the home currency is going to be the euro. So based in Ireland, we're euro, okay? And when we're exporting goods, we are selling those goods to the Russian customer, and the Russian customer is going to pay us in ruble. So we're receiving ruble. That's not our home currency. So we need to sell the ruble and we need to buy the euro. So because we're buying the euro, customer uses the offer to buy the home currency, which is the euro. So if you want to just write this down in terms of the bid rate, CBS, customer uses the bid to sell the home currency. So CBS euro, just to let you know, all our home currencies in the questions will be euro. Okay, or whatever the company, more than likely it will be euro. Okay, so CBS euro, customer uses the bid to sell the euro, and CAB or COB euro, customer uses the offer or the ask to buy the euro. So the exporter in this case will always be using the offer or the ask rate if you want to just kind of cut it. So there are some notes that you need to kind of in your answer just write them briefly down. So the exporter will always use the ask or the offer. Okay, so now that we have that, we are going to be using is 61.28, and we also have a 4% discount rate if this customer actually pays immediately. So this is where we're coming from here. If you notice, this is the amount of money that we're receiving. If we convert that by 61.28, which is the current spot rate, this is the euro equivalent that we have. And we're only going to get 96% of that. Why am I multiplying it by 0.96?
Because they get the 4% discount.
Yeah, the 4% discount. So we're not getting 100% of it. We're only getting 96% of it. So we're multiplying that by 0.96 to give us this amount. You might approach it a little bit differently. You might decide to get 96% of the 8.42 million and then convert it. Could anyone just do that with a calculator if you have a handy? I have my phone here handy. It's the same. Okay, so just note that, okay? Because we're leading the payment, that doesn't mean we're just going to receive this. Okay, we don't have anything really to compare to over the next 4 months in terms of putting that money into a risky venture. So what we're going to do is use an opportunity cost so that we can compare it with the other hedging methods. And we're going to, because we've received this money today, we're going to invest that for a 4-month period. Okay, so remember, we were giving them 4 months to pay. If we hadn't that money, okay, we wouldn't be effectively, we obviously wouldn't be earning anything, but now that we have it, we could earn something on this. So we're going to invest it for 4 months. It's always going to be invested in Ireland. So I'm going to go back up here, and we're told that in Ireland, which is the home country, the borrowing and the investing rate is as follows. So that's why I have the 1.8% here. We're investing for 4 months at 1.8%. Okay. Sometimes we mistakenly, by rushing into it, we might see that as 0.18. Okay, so remember, always just take a moment and divide that percentage by 100. Okay, so we have the 0.018 for a 4-month period. That's why we're doing it by 4/12. And for that 4 months, we're going to earn interest of about €791. Okay, so our money has slightly grown. Okay, from 131,906 to 132,696. Okay, so we've kind of recovered a little bit back on our, the discount that we had offered, but not much, but it's something. Okay, so we're going to take that with us. That's one solution. That's why I have it highlighted here in red. What we're going to do then is move on to the next one, which is the forward contract, which is straightforward enough compared to the lead payment. Okay, so going back up here, let's look at the forward contract. All right. We don't have any bid or ask for the forward, so I just left it like a one adjustment. Sometimes I will put in 2. Okay, I might have a 1.2 and a 1.3, for example. With the ruble, I might have a 1.8 and a 2.1. And again, you'll see that in some past exam questions. In this one, I've only the 1 on there, so don't let that put you off. So regarding the forward contract with the Russian ruble, do we go with a 3-month or a 4-month adjustment?
4 month. Is that?
Yeah. Exactly, because we offered 4 months credit. Therefore, they have 4 months to pay us. Just to brief you on what a forward contract is again. A forward contract is an agreement with a third party, like not with the company that you're doing business with, but with another party like a bank, or it could be a broker, and you're worried about changes to the to the exchange rate. And therefore, you want to try and lock in an exchange rate today so you can exchange in 4 months' time at the rate you were contracted with this third party. So they might make adjustments because obviously it's not a fixed exchange rate between the Russian ruble and the euro. It might have some kind of free floating exchange rate with each other. So there are fluctuations. So based on whatever calculations or permutations they come up with, they have an adjustment here of 2.5 ruble, and we are going to make a change to the ask of by the amount of 2.5 to create our forward exchange rate. Okay, and that's the contract we're going to lock in at, and we know today what we will convert the money when we receive in a 4 months' time at. But the next important thing to note here, and you will always see below this table, is whether the exchange is, or the currency is, a premium or a discount adjustment. We're told here for the exporter, the Russian ruble is a discount adjustment. You know what to do with that adjustment, don't you?
You add it.
You add it on because we're dealing with indirect quotations, and even though we see discount as like a subtraction from, say, retail, if we're looking to buy something and there's a discount, with the indirect quotation, it works the opposite way. And with a discount, you actually add it on. So we were dealing with the ask all along, okay? And we're going to add the 2.5 onto this 61.28. So we should see that as one of our first calculations for the forward contract. So 4 months credit is given, fine. There it is, look at 6.28 plus your 2.5 will give us the forward contract that we're going to lock in at today at 63.78. So therefore we know that when we receive this money, we're going to get this for it, and that's guaranteed, irrespective of the exchange rate outcome. The exchange rate outcome could be worse if we hadn't done this, which is good, or it could have been better for us, which isn't that good for us. So at least we know we're removing the uncertainty by locking in this forward contract rate of 63.78. And if we were to compare, if these were the only two that we were working on, we were to compare the two of those figures, they're quite similar. But of the two, which is the better one? This was the lead payment. Would you go lead payment or forward contract?
Lead payment.
Yeah, it's better, but yeah, exactly. It's better by about 680 quid. Okay. There's issues around that, of course, whether we're going to get the Russians to pay us immediately. And there's also assumptions that the rate here, 1.8%, is going to be fixed over the 4 months. And we can see how quickly rates can actually change in such a short period of time that we might not get this at all. Okay, we might get a substantially less, almost a 0% return on that 4 month investment. Okay. Anyway, we still have one more to do, which is the money market hedge, or again, you might have seen it before as foreign currency borrowing. So if you see this on past exam papers as foreign currency borrowing or in the notes solutions that we've done, don't worry about it. Okay, it's the same thing. Okay, this is an important thing. This is another piece you might want to write down. So we already wrote down whether we're going to use the bid or the ask, exporter ask, importer the bid rate. Okay, and why? Just have that idea in your head because it's important for the next question as well, which one we're going to use. But regarding the foreign currency borrowing, we have to find out whether we're going to be borrowing abroad or borrowing locally. And it all depends on whether we're an exporter or an importer. For the exporter, I want you to write this down. So put in your heading money market hedge or foreign currency borrowing. Exporter, you're going to borrow abroad, invest locally. I'll explain in a minute why. I'll just give you a chance to write that down. I'm going to explain why. If you want to write down why, fine. If you have enough by just saying, look, I don't need to know why. I just want to know what I have to do. So, it's up to you. And then I'll explain for the importer. And remember, right, for the exporter, you've sent out goods to, in this case, Russia. So you've exported goods and you want to receive money. You do not want that money in 4 months' time. You want the money today. So if you know the Russian company is going to pay you in 4 months' time, you want them to pay you in, say, a Russian bank account. Okay, it doesn't have to be based on Russia, but it could be what we call a euro ruble account. We don't have to go there really, but they'll pay you in a Russian bank account. You do not want this money in 4 months' time because it means you're exposing yourself to exchange rate risk. So if you borrow the money in Russia, that's where we're going to borrow abroad. So we're going to borrow abroad. We're going to take the money back to Ireland or deposit it into a euro denominated bank account. Okay, and that's going to again happen on the same day, therefore taking the spot rate. And you just wait for the next 4 months. And when the Russian is to pay you the money, you will direct them to deposit the money into that Russian account where you borrowed, and they'll pay off your loan. Okay. But in the meantime, you're going to leave a little bit behind in that Russian account to pay off the interest. Okay, so let me just explain with the calculation what we're going to do, and then I'll go through that explanation again if it might help. Okay, so what we have here, borrow abroad, invest locally, just think of that e-bail. If you remember, write down here, we did it in class, e-bail, it might help, E-B-A-I-L. Okay. So again, have that ready for you when you're doing this. So you need to note all these. I want to see this on your paper, okay? Borrow abroad, invest locally. I have percentages here, 8.1% and 1.8%. Let's go back to see where I actually got these. This is available in the question. So you have these interest rates here, Okay. Remember the mantra, borrow abroad. So you're going to borrow abroad, 8.1, and invest locally, 1.8%. Okay. And that's why I have those rates chosen. Borrow abroad and invest locally. Okay. Now, for the exporter, it's done chronologically. The steps that we're going to do here is done chronologically in terms of we're going to borrow the money, convert it today, and wait for 4 months to be paid. And later on, I'll show you the importer. It's done in reverse order. So the investment is done, which is the last thing you'll do, but in terms of helping us with the calculation. But again, I'll pick up on that soon. I don't want to confuse you at the moment. So you're going to have 3 steps. I'd advise you to leave a space in between each one of these as you're answering, maybe 2 spaces, just in case you have a bit of working like this. You don't want to make it all untidy for yourself, make it a little bit clearer. Okay, so we're going to borrow 8.42 million ruble in the Russian bank account. Okay, they're going to quote us an interest rate of 8.1% for a 4-month period. That's why I have here, again, divided by 100, just to make sure you do that, 0.081 by 4 over 12. Okay, and we're going to add it on to your 1. Okay, that's why you have this red figure here, 1.026973, representing this. And we're going to divide that into your 8.42 million, which means that this here is not euro, this here is ruble. Okay, which means this is what we have left once we borrow the 8.42 million ruble. Okay, why am I going to convert this into euro and not the 8.42 million into euro? Why am I missing about 222,000 ruble?
You have to leave the interest payments there to be paid.
Yeah, everyone get that? Not that I'm going to be asking you this in the exam, okay? It's just the expectation that you'll understand what's going on here. So I won't be putting you on the spot in the exam as why. But just a note, if you have that query, reason why I'm not converting the 8.42 million, taking it all back, is I want to leave a little bit behind so that it'll pay off the interest, the 8.1% over that 4-month period. So that I won't. So if I took it all back with me, it means that in 4 months' time, I'll have to, or on a monthly basis, I have to pay interest, and that's taken in. It's only minor, but it's taken into account some exchange rate exposure. So leave that 222,000 behind in the Russian bank account, and when they request interest repayments, it's just going to work on that and deplete that over the 4 months. We're going to take this back, and this again is ruble. We're going to take this back and convert it at the ask price. There we see the 61.28 again. Okay, and where am I getting this? This is going back to that first part when we looked at the forward contract, 61.28, see it there? And we also saw it here in the lead to payment. And we're getting all of that from your question where we first established that we are going to use the ask rate because we're an exporter, 61.28. Okay, so we're converting it, these are called the spot rates. We're converting it at that spot rate, 61.28. Okay, in euro, if anyone can check this figure for me, if you get the 8,198,852.36 divided by the spot, just make sure that euro is correct.
Yeah.
Great.
Yeah.
Okay, so that's what we have today. What we're going to do is we're going to not just let that sit idly by. We have the money, like what we did with the lead payment. We need to do something with it. Granted, you could go and invest it in your business or whatever it is, but we don't know. We don't have any information on that. So we'll take the risk-free approach, and we'll just invest it at a risk-free rate of interest. In other words, invest it in a bank account. And that's what we're doing here. We're investing this money in Ireland. Okay, remember it's invested locally at 1.8%. That's why we have 0.018 for a 4-month period as well. Okay, we added on to the 1. And because we're investing, we're getting more, so we're going to multiply it. And that gives us the 134,500 euro. Okay. Now, comparing that to the forward and the lead payment, compared to these two, the 134.5 is a better hedging method. because we're getting an extra 2,500 relative to the forward contract. And comparing this to the lead payment, again, it's better than the lead payment by about 3,000 or by about 2,000 euro. Okay. So the advice here is they should use the money market as their hedging method. Black and white, okay? And there could be a question later on, and there might be, I'm just going to scroll back up. It's always a kind of a popular question to ask, by the way. I'll just scroll down and see if I have it. Yeah, there it is. Okay. We'll see this soon. Explain why they're more likely to use forward contracts as opposed to foreign currency borrowing, even though the rates are better with the foreign currency borrowing. And that's exactly what's happening in this question. The rate is better. We don't know what the actual rate is, but if you convert it into euro, looking at our answers, the rate is better because we're receiving the 134,500 for foreign currency borrowing compared to the forward contract and compared to the lead payment. And we're asking in that question, why is it still better to use the forward contract as opposed to the money market hedge? Does anyone want to jump in and answer that quickly? Maybe just the 1 or 2 points on it.
Well, the interest rate can change, get lower, so you get less money from interest. But at the same time, if you do have the forward contract, you kind of save the spot rate.
Yeah,
use.
Exactly. That's one point, and that's one thing I actually don't have in my solution. Okay, but it's a really good point. So you don't have to stick with any kind of model answers, if you want to call it that. Always elaborate or bring in your own. So definitely you're dealing with exchange rate, interest rate risk, because here these rates, unless they're assumed fixed, they may change, and your borrowing rate could go up, it could go down and benefit you. And likewise, your investment could go either way as well. So you're going to end up with slightly more. What else could be a problem with foreign currency borrowing or the money market hedge?
The company says it mightn't suit them. They mightn't have bank accounts in different countries.
Yep.
Yeah, they might just it might suit them to use the forward contracts.
Yeah, it's definitely build up on that. Okay, so that's pretty much in a nutshell for everybody. But build on it or elaborate on it a little bit. Okay, saying that you may not have a bank account, it may be something a new customer. We don't know anything about this relationship here, and it's very difficult to get a Russian bank account opened. And if it's going to be a matter of a couple of weeks before you open it, you're going to be still exposing yourself to exchange rate risk, because the spot rate could change over that 2-week period, for better or worse. It could still change, and therefore you don't want to be waiting around for that. Therefore, the forward contract is optimal because you can lock in a rate today. So that's how we elaborate on those type of things. Another thing to elaborate on, you might be a small company and this is relatively small amount of money compared to larger multinationals. If you're a small company, they might not even want to be, the bank may not be even interested in you. And even if they are, they're going to look for collateral. They're going to look for credit ratio, credit history, and you may not be able to have that available to you. Fine if you were working in advance and expected that this was going to be a possible export to a Russian company, you could have had all this set up in advance. But other than that, it's unlikely that's going to happen. Okay. So look at, I have a few points anyway below. I said you could mention, that's why I said it loosely. So first point is not in here, so you could mention that. There's your creditworthiness, your character, capital. It's all the 5 C's you might have come across in a previous module last year, the year before. Okay, so there's a few things to point out there. And that's typically a 6-mark question.